to Wake Up with Cheddar. Turning now to the markets. U.S. futures pointing to a lower open to begin the trading week. Prices for crude oil and natural gas continuing to rise, drawing major indexes down. Futures of Brent crude nearly $84 a barrel, close to its highest level in 3 years. Investors also anxious to see whether the market can overcome inflation concerns, labor shortages, supply chain disruptions, and higher prices for energy and goods. They got a lot on their plate. So for more on the markets, I want to bring in Thomas Hayes, chairman of Great Hill Capital. Good to have you this morning, Thomas. And we want to know,
Thanks for having me.
The jobs report came out on Friday. Numbers are disappointing. What do these numbers tell us about the labor market right now?
Yeah, so it was a big miss, Ken. Thanks for having me. 194,000 versus 500,000 estimated. And you still have 7.7 million unemployed. That compares to February 2020 pre-pandemic of 5.7 million. Unemployment rate is 4.8 versus 3.5 before the pandemic. And the key thing is the labor force participation rate is just stubbornly low at 61.6. You know, prior to the pandemic, it was at 63.3 at its peak. And if that was to reverse over the next 6 to 12 months, that would be 4.3 million people into the labor force. We'd probably have the lowest unemployment rate in history, but it doesn't look like that's going to happen in the short term. But the key here, Ken, I think, is how does this affect the taper? Because that's what the market is fixated on, is rates and taper and when and how. Chair Powell at his last press conference, he said that while we've met the criteria of substantial further progress as it relates to inflation, and I think, and then some, as it relates to full employment, we're not quite there. What he would need to see in order to be there would be a decent jobs report, decent employment numbers, and we did not get that on Friday. I think that we'll see better reports in October and November as Delta winds down and people get back to work. The benefits have rolled off, but September was a tough month. You know, the first 2 weeks of September were really strong as it related to Delta. There was a lot of concern out there. So the next Fed meeting is November 2nd. He's not going to have another employment report before that meeting. So the earliest I think we're going to see a taper announcement would be the meeting December 14th and 15th. And that's later than people had been anticipating. And then maybe you see an implementation either late December, but more likely early 2022. So that jobs report did, in our view, change the timing of the taper, and that'll have a big impact on the market moving forward.
So early 2022, that's when you think the Fed will actually begin tapering, because as you said, the numbers are not great. The chairman knows about it, and it seems like every time we're about to get some breath of fresh air when it comes to the job numbers, they tank. So what are we aiming at? You said 2022?
Yeah, I think early 2022 implementation. And remember, he's up for reappointment in February is the break point. So maybe the boat's not rocked before then, or maybe he wants to get it ahead. But I think the expectations have changed. I think people were pretty certain it was going to happen in November. And now that the earliest that anything's going to happen is mid-December and likely early next year. And then as it relates to rate rises, that pushes that timeline probably out a little bit to rather than late 2022. Early 2023. So the name of the game is the Fed is going to remain accommodative. And even if you consider taper, let's say it did start in December, it would be an 8-month process. Let's call it $15 billion a month. During that period, the Fed balance sheet would still expand by about $660 billion from reinvestment, from the purchases. So the liquidity is going to be ample, just like we saw in December 2013 is when they actually implemented taper. And you saw the balance sheet increase for many months afterwards. And also in anticipation of taper, you know, the S&P 500 in 2013 was up over 30%. And then in 2014, when people thought, the liquidity is coming out, the market was up still mid-teens for 2014 while the taper was happening and completely unwinding. And then the Fed balance sheet stabilized. So it's nothing to tremendously fear. It may be a little bit more bumpy in 2014 than it was in 2013. Maybe you'll see more than a 5% pullback. But on balance, things look good. But the name of the game right now, we're today in an information vacuum. Everyone is looking forward to earnings, which start on Wednesday.
Yeah, I was going to say we have some big third quarter earnings coming out for some big companies. What are you expecting? What do you think you'll see?
Yeah, if the recent past is any prologue, first off, we start off with the banks, J.P. Morgan on Wednesday, then we've got followed by Wells Fargo, Morgan Stanley, and Citi on Thursday. So that's going to set the tenor for the entire earnings season, and I think they're going to be good. I think both the earnings are going to be good, the guidance is going to be good. They're going to be releasing more loan loss reserves. The yield curve has been historically steep. It's as steep as it's been in the last 5 years. With the taper, the market's anticipating taper. We've seen the 10-year yield move from 120 bips to 161 bips in a very short period of time. That's probably going to push towards 2% as we get closer to taper. So we could see a 10-year yield with a 2 handle by Q1 of 2022. All of these factors help the banks. That's going to help their guidance. And guidance is really the name of the game because earnings are expected to grow 27.6% in Q3 year on year. But if we look over the last 5 years, they usually underestimate by 8.4%. So while everyone's looking for 27%, we'll probably wind up with 35%. However, if you look at the last 5 quarters, they've exceeded by high teens, call it 18%. So we could see, best case, if the recent past is any prologue, we could see earnings growth of over 40%, 45% this quarter, and no one's looking for that. And what that means, it's not just, the history of, growing in Q3. It is they will have to take guidance up. And I think that is really the name of the game. Guidance had been rising for many, many, many months. And the market's a little worried because in the last 4 weeks, guidance for 2022 earnings has been flat, if not a little bit down. And that's concerning. As guidance goes up, right now the market consensus is that earnings will be about $220 on the S&P for 2022. I think what you're going to see before year end is $230 and maybe even more based on these beat rates. And then the multiple, which is currently 20.5 times earnings, 20.5 times next year's earnings versus the 5-year average of 18 times, that could actually start to come down as earnings go up and make the market look a lot more reasonable. So, analysts, bottoms up consensus earnings have a 12-month price target, which is 14.8% above the current levels. So they're looking at an S&P 500 of 50-55, 12 months out. I think with 14% earnings growth next year, to have a rise with 10% earnings growth next year, a 14.8% increase in the S&P 500 is certainly not out of the question. So we're pretty positive and pretty optimistic looking forward based on the numbers we have at hand.
Thomas Hayes breaks it all down, doesn't skip a beat. Thank you. He's the chairman of Great Hill Capital. Thomas, thank you so much for being on the show and have a great morning.